Banks are beating industrials, Bank of America will have its day in court, and we're taking a look at the week ahead. You're in the right place, folks, because this is where the money is. Welcome to the show, folks. It is Monday. I am Matt Copenheffer, and sitting right here next to me is David Hanson, who, by the way, is having a terrible Monday so far.
Not a good Monday.
David, what is at the top of your list of all the things going wrong on this Monday?
Trying to sell my car right now. Thought I had a deal in place last night. Check engine light comes on. $700 worth of repairs this morning.
When did the check engine light come on?
10 minutes after I sold it.
10 minutes after you sold it.
Not a good time.
What is it going to take to turn your week around at this point?
Oh, man, just getting it out of my possession. That's
What about a phone call from Ben Bernanke? If he called you up and said, David, I'm sorry.
I'm sorry that everyone talks about me all the time. I'm sorry to be the center of attention. Maybe that'll cheer me up a little bit.
All right. Well, we've got a good show today. Hopefully that'll help turn your day around. We'll get you thinking about the banks and markets here. Starting off, we've got an article from the Wall Street Journal about data out of China. The article reads, China's economy showed fresh signs of vigor as an initial gauge of manufacturing activity strengthened in September, reaching a 6-month high. Sounds like good news to me. What's your take?
I guess it's good news. I know there's a lot of worries about China's banking system, just the Chinese economy as a whole. For investors here that are investors in financial institutions, insurance companies, banks, I think the important thing to remember is, okay, if there's something that happens in China that really hurts their economy, it's going to reverberate throughout the world, and there's going to be some companies that feel the pinch. In terms of company-specific problems, when you talk about the banks, a bank like Wells Fargo, they don't really have a lot of exposure over in China. Mm-hmm. A bank like Citigroup, maybe a little bit more. Bank of America has recently exited their stake in China Construction Bank. So the American banks have been scaling back their exposure to China. If something was to happen, it doesn't mean the banks are going to be completely fine, but I don't think it's a glaring red flag.
Yeah, it's hard to ignore what's going on in China in general, given the important role it plays in the global economy. But like you said, and we're talking about this a lot on this show, if you're an investor in Citigroup, this is the kind of thing that you particularly need to keep an eye on, because they're heavily weighted towards the emerging markets, and that's a big part of the story there.
Yep. Next headline looking at, I think it's from Bloomberg. Yep.
It is from Bloomberg.
Banks prove safer than industrials in bond rally. Credit markets. Banks are safe? What's going on?
Look, we've been saying this. This shouldn't surprise anybody. The banks, the capital position at the banks and their balance sheets, it's changed so much since the financial crisis and since before the financial crisis. Let me just read a quick bit from the article here. Relative yields on bonds from Citigroup to JP Morgan Chase were 3 basis points less than the average for industrials notes last week. The first time since September 2007 that investors didn't require more from bank borrowers, a Bank of America Merrill Lynch index data shows. So I went back. This is data from the FDIC, equity capital as a percentage of assets at banks. Mm-hmm. So right now, as of the end of the second quarter, the equity capital as a percentage of assets at banks, these are across all sizes of banks, 11.19%. And if we go back to before 2011, the last time that ratio was that high was never, or at least as far back as the data goes for the FDIC to 1984. So the FDIC has been watching this all the way back to 1984, keeping track of this all the way back to 1984. The capital ratios have not been this high. There doesn't surprise me at all that bond investors are liking the banks right now.
Yep.
Number 3. We're going to the FT for B of A set to defend fraud claims in court. And we were talking about this earlier. This is different than all of the reps and warranties claims that Bank of America has gone through. This is fraud.
Mm-hmm. Yeah, so different. Fraud. Yeah, so with the
alleged fraud.
This is again talking about the GSEs, Fannie and Freddie. Like you said, the reps and warranties, that stuff was settled. This is still hanging over the stock in the bank a little bit. In the article, it said that they were seeking $1 billion as a penalty there. So not that big of a deal. $1 billion, certainly a lot to us. We just saw JP Morgan pay out about $1 billion in fines over the London whale. So again, it's a little bit of an overhang, but it's not something very material to the bank.
Here's what I think is particularly notable about this. This has to do with FRIA claims. That's from this is savings and loan era regulations. And two things that are notable about FRIA claims is that there's a 10-year statute of limitations. So it gives the government an increased amount of time to be able to go after the banks. Number two, it's only a civil burden of proof, so it's a lower burden of proof for them to overcome. Now, these regulations, the idea was that they're looking for fraud that affected banks that are insured by the government. And Fannie Mae and Freddie Mac are not banks that are insured by the government, so they would fall outside of that. But Bank of America is insured by the government, and so the claim here is that Bank of America harmed itself. And so the government is going after it for harming itself as a federally insured bank, which I think is pretty silly. But so far, the judge in the case has gone with this interpretation, and we're going to move forward and see what happens.
We'll see. All right, let's move on to our next segment. Look at 5 headlines, a little bit quicker, rapid fire style. The first one I was looking at was from the FT. Twitter seeks pre-IPO credit line. So Twitter going public, going to raise money through equity issuance, but now they're also getting a credit line, which is, some people might say, well, what's the point of that? So they're getting a credit line, and the article was talking about how it's interesting that a lot of these startup firms will get credit before the equity, so they give a little more flexibility with their financial position. And they're saying that banks, the investment banks, JP Morgan's the world, Morgan Stanley, Goldman Sachs, they'll give them better terms on the credit facility in order to win the IPO process. So there's a little bit of wooing there. Just thought that was an interesting story.
Yep. Over at the Wall Street Journal, got an article about Janet Yellen, the potential candidate for the Fed chair spot. Title of the article is "Yellen Would Bring a Tougher Tone to the Fed." It's a really good, I think it's a good profile of Janet Yellen, gives a little bit more color to this potential Fed chairwoman down the road. It talks about how she's not just the soft touch in there, that she is a little bit tougher and may rankle some people. I'm okay with that. The problem I had with Larry Summers was that there was going to be a big fight. You know that there was going to be a big fight trying to get him through.
Yep. Next one I was looking at was don't bet the house on home builder shares. So a lot of people are looking at the home builders, the KB Home, the Lennar, the Hovnanian, and when you look at something like housing starts, we're trending way below kind of the historical rate of what we've been building houses. So it's easy to say, well, these are a guaranteed success here. These companies are going to do great when they have to build more houses. But the article was pointing out that the valuations are much richer than they were even pre-crisis era. So just if you're interested in these home buyers, don't just think the thesis is that simple, that they're going to build more homes. Look into the valuation, see where the good deal is.
Another one from the Wall Street Journal here, rethinking Fannie, Freddie, and the 30-year mortgage. Another good read here. A line that I really liked from this article is, the firms are proving to be as difficult to shut down as the U.S.-operated Guantanamo Bay prison in Cuba, which is true. What I think is interesting here is, they talk about the stickiness of the 30-year mortgage in the U.S., which is not prevalent around the world. I think when it comes to Fannie and Freddie, what makes sense may not happen. And what makes sense, if it's going to happen, probably won't happen quickly. So this is a process that's going to take a lot of time to play out.
Yep.
And it's going to be difficult to watch, and it's going to be difficult to assess and handicap, particularly if you're trying to bet on those stocks.
Yep. Fifth and final headline from the FT again, blow for Citi as trading revenues drop. So their sources saying that we saw Leucadia last week come out and say Jefferies trading revenue was much lower. I think something 87%, maybe 83%. Their sources saying that Citi's going to report lower fixed income trading revenue. Again, this is going to be an industry-wide type of thing, considering just the nature of the past quarter. I don't see it as a big deal. Fixed income trading in general, is very cyclical. Citi's going to work through these fluctuations of the market, so it may be lower, but as a long-term investor, I don't think people should be worrying about this.
Alrighty. Moving on to a look at the week ahead. We've got a bunch of things scheduled on the docket for this week. Is there anything in particular that you are looking forward to or not looking forward to, or you think will have a big impact on the markets this week?
The piece of data that we get tomorrow is Case-Shiller. So always interesting to see what these numbers look like, looking at 20 cities in the U.S. and kind of where the home prices are moving. Last month, we saw up over 12%. The consensus is for even more than last month in tomorrow's reading. So that'll be an interesting one to watch, just to see, is the momentum still there? So I don't think this will fully price in the mortgage rates that are higher, that some people have been saying this may dampen the rise in home prices. But it'll be interesting to see, if it did squeak in there, because I think the numbers coming out tomorrow are for July. So we're still kind of lagging behind here.
It's always
It's always a lag, but it'll be interesting to see, even if the rates weren't impacting, did it still stand up, or did the rate
is there any? Yeah, are we starting to see that impact that everybody is really worried about?
So that'll be one to watch.
Okay. GDP, we're gonna get the third revision.
Third revision.
The revisions are, I mean, particularly the second revision. This last time around, it went from what?
1.7.
1 yeah, was it 1.7 or 1.8? Around there to 2.5. So that's a pretty big revision. I don't think generally, I didn't check the data ahead of time, but I don't think generally we see that kind of thing on the third revision. I think that's generally the earlier revisions. But nevertheless, I guess it's worth tuning into to see what's happening there. You were mentioning to me that National Bank of Greece is presenting at the B of A conference in London tomorrow.
Yeah, that'll be interesting just to keep an eye on what their comments have been. Obviously, Greece, National Bank of Greece went through a huge dilution process. Not a fun time to own the shares a couple months ago. But just what does the recovery look like? A lot of people might be looking at Europe and saying, okay, are European banks what the American banks were 2 years ago? And really catch that recovery. They're not apples to apples. There's some different concerns going on, especially in a country like Greece. But it'll be interesting to see where do they see the business going the next couple of years.
Well, also, we were at the Value Investing Congress last week, and there was one group that was presenting on a Greek REIT as a potential opportunity for value investors. So when you think about a country like that, and when you think about some of the struggling areas in Europe in general, maybe there's opportunity there, particularly value-based opportunity. When we think about the U.S., where valuations have moved up, prices have moved up, and maybe it's a little bit harder to find value in the U.S., so maybe you look over there. It's not just National Bank of Greece that'll be at this Bank of America conference. It's going to go on Tuesday, Wednesday, Thursday. We're going to hear from Santander. I believe Santander was also Tuesday, maybe Wednesday. Lloyd's was Wednesday, and then Barclays, I think, was Thursday. I may have those days mixed up, but Santander, Lloyd's, and Barclays will all be presenting there. Those could be interesting to listen to just from the perspective of how Europe is unfolding. And then Bank of Nova Scotia up in Canada will have its Investor Day on Wednesday. And we've talked a little bit about our concerns about Canada, about the housing market up there, about the state of the banks. And when we talk about U.S. banks, we were just talking about U.S. banks and the capital ratios there. And how they're holding tons of capital. Not quite the same in Canada. So when I think about the safety of banks, it's, in my mind at least, it's flip-flopped a little bit. If you look back to prior to the financial crisis to now, before, U.S. banks not quite as safe, Canadian banks a little bit safer. Now I think it's maybe a little bit the opposite.
Yep, I agree.
All right, moving to our game for the day. We've got some Grade It here. And again, this is... So I'm going to present two scenarios.
Okay.
In each one, we're going to draw ourselves a little picture to illustrate what we think about that particular scenario, and then back up our beautiful artistic rendering.
Let's do it.
First of them, the Fed's no taper call last week. What is your grade?
Alrighty, my grade. Let's see here.
Whoa, that is a lot.
We got a lot of stuff going on here.
I don't even know.
All right, this is my grade. You said we get to explain our artistic ability. Yeah. Okay, so here's me.
Ability might be stretching it a little bit.
Over here, just in the abyss, all by myself. This over here is the Fed. These are computers, documents. They've got all the data. They've got a team of economists right here, and I'm giving them a check mark. There's a lot of people that want to question the Fed. What are they doing? Why didn't they take this opportunity to taper back on the program? Everyone's got an opinion about it. I'm going to say, look, I think the Fed knows more than I do. I'm willing to admit that. They know more than I do about the economy.
Is that right?
They have more data than me. So I'm saying, give them a check mark. They have the data. I do not. What say you?
Right. I've got this sorry-looking guy right here. It's we've got the X's over the eyes. That's sort of the classic cartoon dead character kind of thing, tongue hanging out. Got a lot of question marks over the head there. So this is all about the Fed being in a position where they don't know what can they do. What can they do? They've pushed monetary policy as far as they have been able to. They've done everything that they can to try to spur the economy, and meanwhile the federal government is cutting. Doesn't want to support the economy with any more stimulus or anything like that, and in fact is cutting jobs. We've got the sequester. We've got all these concerns over the debt ceiling. And so Bernanke's kind of stuck. So he's playing the only cards he can, which is let's continue buying bonds, let's continue buying mortgage bonds. What can you do? I'm not happy about it, but I don't see things changing.
All right, what's our next scenario we got?
Next scenario, number 2, the opportunity in bank stocks right now.
Right now. Today.
Right now.
Okay, let's see here.
I see a stick figure over there. Ooh, that looks dangerous.
Okay, this is the opportunity in bank stocks right now. So this is the investor over here. He's a little unsure.
Should I guess what that is?
Sure, let's see what your guess is. What do you think?
This is a family show, David.
Okay.
Why don't you describe it to us? Because what I was going to guess.
Okay, maybe not. Okay, so here's the investor day. A little unsure. Banks have had a great run. Bank of America, Citigroup, both have doubled the last year or so. So there's a little bit of uncertainty. Maybe I'm late to the game. I'm not sure. There's a lot of things going forward that I'm not really sure about. Like you said, we have the debt ceiling. We have the Fed. GDP is not growing that much. And those are the hot coals in front there. And you're questioning, should I walk across those hot coals? But at the end, there's a prize. There's a trophy there. So it's like if you're walking across the hot coals, it's not going to feel great. There's going to be times where you're saying, man, this hurts. But in the end, you're going to be really glad you did it. You're going to feel accomplished, and you're going to have the prize there. I look at the big banks. I look at J.P. Morgan, Bank of America. Obviously, there's going to be pain in front of them. You have to deal with
if you've been an investor with J.P. Morgan lately, you're
standing on the hot. You're laying. You're sleeping on the hot coals. So there's going to be the pain. There's going to be market fluctuations, but you have to look and say, where are the good franchises? Where do the valuations make sense? And I look at Bank of America, J.P. Morgan. I think the valuations make sense. Is there going to be pain? Yes, but I think if you power through, you can get to the prize.
All right.
What do you say?
I'm going to go a little bit simpler because there's no way that I can top that. I'm going with a straight letter grade here. I've got B+ with a slash and then a C+. I'm kind of looking at the size split here. Among the bigger banks, I think there's still some good opportunity. That's where I gave the B+. We've seen a lot of stock price appreciation, so a lot of the value opportunity is gone in the bigger banks, but there's still some there, and I think there's good opportunity. When I think about J.P. Morgan, the kind of returns it produces, the earnings power it has versus where it's trading. When I think about Bank of America, the opportunity it still has and the earning power there. Once the legacy costs are out, once the efficiency ratio starts to come down, and then when I look at smaller banks, the reason, so I'm not grading on a curve here. A C is average. A C is okay. So C+ means still a little bit better than okay. I think you can find good smaller banks at okay valuations, not great valuations. They are out there. But I think there's less opportunity with the smaller banks because nobody's as worried about the smaller banks. Everybody's worried about the big banks. It's too big to fail. It's these banks are going to crater again, that sort of thing. You don't get that around like a bank like M&T or even U.S. Bancorp, which isn't really a smaller bank, but the way people tend to think about it is USB is a smaller bank, and I don't think investors are as worried about those, and so they're carrying those higher valuations.
Fair enough.
Ending the day, unfortunately for you, it's the whole day is not over yet. So you've still got to power through the tough times. But ending the show here, we'll say, on Twitter, as we always do. David, give us the first Twitter.
All right, the first story, or the first tweet, maybe some mixed emotions here. The story everyone's talking about today, $100,000 salary may yield retirement, flipping burgers. So this is a story out on Bloomberg about a guy who used to make good money, first-class flights, didn't save enough for retirement.
And you thought you were having a bad day.
Yeah, and he did not save enough for retirement. Back working at 77 years old, I believe, working at a Sam's Club, I think.
Sam's Club and flipping burgers at, I think it was a country club, or golf.
Is this all bad news? What do you think?
Well, I think on the one hand, it's a great story to read. It's a great story to pass around to everybody. If you've got this story, particularly if you know younger people in your life, pass it around to them. Let them read it. Let them see this experience, because I think it's a good reminder of why it's so important to save for retirement. On the other hand, when I think about retirement, is when you describe it as flipping burgers, it doesn't sound so good. What am I going to be doing in retirement? What am I going? I don't like to play golf. I'm not gonna make that a secret. I don't like to play golf. I like to run. At 77 years old, I probably won't be doing as much running anymore. So I don't know. I'll have to find something to do.
Right.
What are you going to be doing at 77? You will be playing golf.
I'll be flipping burgers, but I'll say I'm like a chef that interacts with a lot of people. That sounds a little bit better. The one final thing I'll say about the whole retirement, there's a lot of people saying, well, we're heading for a retirement crisis. People aren't saving enough money anymore. That's nothing new. And our colleague Morgan Housel, I think several months ago, wrote an article kind of dispelling this myth that this is a new problem. It's always been a problem of people not saving for retirement. So it's easy to say this time's different, we're really not saving enough, but that's really been a case, and we're actually making some progress in terms of people saving more and less elderly people being in poverty. So that was an interesting article that Morgan did, and we'll link out to that article below this video.
Okay, moving on to the second tweet of the day. We've got Michael Casey at Mike J. Casey. Meh. That was the market's response to Dudley, third most important person on the Fed, being about as dovish as he could possibly be. And this was in response to a speech given by William Dudley, where he basically said, we are going to flood the market, we're going to continue with the monetary stimulus, and essentially saying we'd rather overshoot than undershoot with this.
Right, and one quote I pulled out from the article, we talk about the Fed. QE gets all the news saying that's what the Fed's doing. They're doing more than QE. They also have the Fed funds rate, which is shorter term. And the quote from his speech was, we might wait a long time after we breach the threshold before we begin to raise our federal funds rate target. And this impacts everyone. Anyone who has a savings account that's yielding basically nothing right now. You're getting pennies from the biggest banks. But on that side, it benefits the big banks. It benefits Bank of America, Wells Fargo, JP Morgan out there. They're the ones with these huge deposit bases, and they're basically getting them for free. So when Dudley comes out and says, that's going to be that way for a while, that's good news for the banks.
I don't know. I guess it is. They get the deposits. They get the deposits and the money for very little. But on the other hand, it's going to continue to depress what they're earning on their investments. And we've seen the interest rate spread continue to compress for the banks. And until the Fed turns things around and we start to see rates creep back up a little bit, that's going to continue to be an issue for the banks. And I personally, as an owner of bank stocks myself, I'd rather see the rates come up a little bit and hopefully see that spread start to widen.
All right, last tweet we're looking at is from Jordan Wathen. We don't have it up there. We apologize.
Apologies to Jordan.
But he is at JWTHN, and the tweet was, old customer priced out of bank account at $25 per month. This is Bank of America, now charging $25 a month. If you
imagine that, Bank of America in a bad headline.
If you don't meet certain restrictions or certain requirements on the bank account to get that waived. But Jordan noted, banks pay about $300 a year, more than $300 a year, to service that account. So yes, they're charging people. I think that it said the woman was a customer for 62 years at legacy banks. So it's not a great headline. But the banks, it costs them money to have these deposits, so they're trying to make a value proposition here. It's saying, look, it costs us this much. We're going to charge a fee. From the woman's perspective, I would say, if you really can't afford it, find a credit union, find a bank that won't charge you. From the bank's perspective and an investor's perspective, you have to be happy that they're looking at this and trying to find the right value, trying to right-size the expenses and the revenue. So feel bad for the lady. Don't necessarily feel bad for the investors. They should be happy. So
my initial reaction is a customer for 62 years. Oh, this is terrible. I don't know any of the details behind her 62-year experience with the banks, the legacy banks, whatever. But it could have been that the banks were losing money on her as a customer for 62 years, which it's a little late for them to be for them to be worrying about that now. This is Bank of America. They are a magnet for bad headlines because of what's gone on. But this is not the kind of thing that we're going to stop hearing about, because a lot of banks are getting very critical of the free checking. We've heard particularly from PNC. They've been very vocal about, we're not really going to do free checking as much anymore. We're not bullish on it. There are some banks, Huntington is one I always like to talk about, that are still big on free checking. And so it's going to be interesting over the next couple of years watching that contrast between the banks that are saying, no, we're not going to do this anymore. We want to make money on our customers, versus those that are still trying to attract with the free checking.
Ending the show with a very happy headline to make my happy Monday.
Yeah, right. That's exactly
everything's cheerful.
It's exactly the kind of headline you
love
need for
it.
the day. Well, that's our show for today, folks. At the end of last week, I promised you that David would be pitching one of his favorite stocks later this week. That is still yet to come after he recovers from his terrible Monday. But that's it for today. Thanks for watching. We'll see you tomorrow.